Hi, what's up guys? It's Gaddy Trades. I got a video for you guys today about liquidity. Now I'm not going to go into too much depth about the advanced concepts of liquidity and how it moves the market. I am going to touch on it a little bit, but the priority of this video is to tell you guys how I use liquidity in my trading. And doing so, I'll cover some basic things like what is liquidity, the idea of stop losses, and as well as how I use it to find narrative, frame a trade, and enter a trade, right? And I'll give you guys some examples. So let's get started. Okay, here we are on slide number 1. You can see the big red sign says, what is liquidity? Now, ICT's definition of liquidity is the degree to which an asset can be quickly bought or sold without affecting the asset price. Now, obviously, most of the people will not understand what the hell that means. I'm going to explain to you guys. The answer is very simple. The basis of liquidity is stop losses, right? Now, there are other forms such as limit orders and traps. However, we're going to be covering the bulk of liquidity, and the main focus of this video is going to be stop losses. So you guys all know what stop losses are. Buy side liquidity means buy stops or stop losses from short traders. Sell side liquidity means sell stops or stop losses from buy traders. So what exactly does that mean? So buy side liquidity, as you should know, it rests above swing highs. So right here, I've labeled out this swing high as buy stops and this swing low as sell stops. What does that exactly mean? If you don't know, buy stops are from short traders. So usually when traders go short, they'll put their stop loss above and high, meaning that there's liquidity above that high. So if price were to go up there, right, smart money would pair orders and these stop losses would get rated. So people would lose money once price came up here because their stop losses there from short traders, and then vice versa for sell stops. So that's the kind of idea about how liquidity works and stop losses. So what's the importance of this, right? So we're trading ICT, we're trading smart money concepts. Smart money will pair long orders with sell stops. So as price comes down here, that's where smart money is looking to buy, right? And smart money will pair short orders with buy stops. So when price comes up here, smart money is looking to sell. That's kind of the basis of liquidity. And just using those simple concepts, you can pretty much find your narrative and bias. You can frame an entire trade idea, and you can even use it to enter on a trade alone. And I have this little thing down here. It says see the liquidity or be the liquidity. Now, I'm sure you guys have heard that before, but it's very important because if you do not understand where liquidity is in the market and where it's likely to go, you're more likely than not going to get stopped out, right? Hey, especially if you've ever been stopped out of a trade and then it plays out in your favor, you were liquidity in that trade. So you really need to understand how the market moves and why it moves. And obviously there's more concept to that. My next video will be about imbalances, but this one's going to be focusing on liquidity. So let's move on to the next slide and I'll tell you guys how I use it and give you guys some examples. Okay, so this slide's very simple, how I use liquidity in my trading. So using what we learned from the previous slide, I can use liquidity in my trading to understand where price is going to go. So in terms of my model, which is up here, that'll help me with narrative and drawn liquidity. The second thing I can use liquidity for is framing trade ideas. So in the third part of my model, higher time frame PD arrays, right? And then the last thing is when paired with time and other confluences, entry confirmation. So you can see how liquidity kind of plays a role in every single aspect of my model, and it's important to understand that this is fractal. So allow me to show you this. And before we move on to the next slide, I want you guys to remember that I said smart money will pair longs orders with sell stops, and smart money will pair short orders with buy stops. So understanding where smart money is going to position their orders and how the algorithm moves price is the concept and the basis of being able to frame a trade idea and enter with high probability that you're not going to get stopped out. So let's move on to some examples and I'll tell you guys kind of what I'm talking about here. Okay, so a lot of people requested me to do some gold examples because I always do the indices. This works on all assets, so I'm going to do gold in this case. So this is a price fractal, time fractal. It's Thursday, July 4th is this candle right here. And I'm going to explain to you guys what went down over here. So before anyone says hindsight, if you guys are in the Discord, you know I always give you guys my drawn liquidity, my higher time frame analysis. This was from a while ago, and we've been spot on with gold about it coming back here and then what happened afterwards. So that's why I'm specifically using this one. So if you're in the Discord, you probably know that we've had our eye on this high when we were back in June. So or the beginning of July. So let's discuss what happened here. So like I said, you cannot just use liquidity. So you can see in this price range, I've marked out the dealing range, discount and premium, which I'll make another video on later. And I've marked out this weekly imbalance as well as this SMT divergence. So if you guys have seen my narrative video and my bias video, as well as my SMT video, I put those videos out first because it's very good to have that kind of background of what those exactly are, because you're going to use those things paired with other things to determine, in this case, narrative, which is the first thing I use liquidity for. So as you guys know, smart money pairs longs with sell stops, right? So we have this SMT divergence right here at a key level, which again, if you see my video, you would know that's very high probability. So in this case, silver actually made a lower low, which means sell side was swept on silver. So these stop losses were rated. And what do we know about stop loss raids? If we're bullish and stop losses are rated, right? And we have other things playing along, we can expect smart money to pair orders here, right? So smart money pairs longs. And which asset is more heavily favorited? It's this one right here because of the SMT divergence. So smart money pairs longs right here. And to play off that idea, we have the SMT divergence and the weekly fair value gap. Now, where can smart money pair longs to? So this is the idea of liquidity and how the market moves. So I'm going to touch on it a little bit. So where can price go, right? So smart money is entering down here. And we even have that external manipulation in a discount. Where can smart money look to distribute positions? Because now that they're entered long, they got to distribute their position. Where are they looking to distribute? Buy stops, which is unwilling money, which we can discuss in another video. But as you can see, I'm marking out the swing highs here. So that's swing high, that's swing high. We also have this imbalance, and then the ultimate objective right here, which on the higher time frame I believe was previous month high, or maybe it was the weekly swing high. But the idea is that the ultimate terminus is right here. It's the high of all highs. So it's like the final buy stop. So it doesn't have to go all the way up there. Whenever smart money distribution is completed, that's when price will likely accumulate or reverse. So what can we expect here? So we saw the S&P divergence at the key level. You guys know that's high probability reversal conditions. But where can price actually go is where it's going to be distributed by smart money. So smart money paired longs, and we can expect distribution to the upside to this high, this high, and this high. And in terms of actually entering on a trade like this, right, we have a change of state of delivery right here on the lower time frame. The higher time frame change of state delivery is right here because it's the double candles. And what I like even more is this fair value gap that just recently formed. So now that we see all of this, you can obviously know what's going to happen now because we have the power of hindsight, and price tapped into the fair value gap, and in due time ended up rating those buy stops. Now, what's really interesting about this is now that price came all the way up here and rated these buy stops, what did we learn about smart money, right? We learned that smart money will pair short orders with buy stops. So when you come back to the slide and we took out these buy stops, we saw a large expansion to the downside, right? So it's the same thing on both sides. I hope this is very eye-opening for some of you. And where could have you entered on a trade like this? We had the inversion fair value gap right here. We had a regular fair value gap right here, right? So in this case, if we move around things just a little bit here, smart money pairs shorts with buy stops, right? So now that buy stops were rated, smart money looks like they paired shorts. And where could you look to get an entry? Right here in the institutional order flow drill, entry drill, this fair value gap you can look to enter. So you can see price entered this fair value gap and distributed lower. Where can price likely go lower to? And you can start expecting some of these lows to get taken out. Now, obviously, other things play into part, right? We had this SMT here, the weekly fair value gap, discount premium. We're not just looking at liquidity, but you can see how that kind of played out right there. Okay, so the next part of this video and how I use liquidity is using liquidity to frame a trade idea. So we're back on the indices here, and I did take this trade in my journal. It's Friday, July 19th. And this is basically what happened. So now the same idea, but scaled down to another fractal and entering a frame to frame a trade idea. Now you could have entered with all this stuff as well. That's on a higher time frame. But for me, I'm a day trader, and this is how I would look to trade this. So let's say in hindsight, we are bearish in this specific market structure. So what would we want to see if we're bearish using the concepts of liquidity? So again, you cannot just use liquidity. So you can see I've marked out this 15-minute fair value gap right here. I've marked out the sell stops. And again, there are sell stops over here as well, right? And this amount of sell stops were already rated. But we do have sell sides here and here, but for now I'm just going to mark out the lower one, which is the final terminus. So I've also marked out 9:30 opening and midnight opening price. As you guys know, I use opening prices in my trading if you watch my live streams every day. But for the most part, you guys can focus on the liquidity here. So what did we learn about smart money, right? Smart money pairs short orders with buy stops, right? So smart money pairs shorts with buy stops. So, and what exactly happened in this price fractal? Price came up into a 15-minute fair value gap, and we had a stop rate. So liquidity was swept, where I've marked out this high, which is buy stops, and buy stops were rated, which is smart money pairing shorts with buy stops. Now, smart money doesn't enter on the 15-minute time frame. However, these concepts are fractal, and you can see this occur on every single time frame. So you can see the buy side liquidity pool was rated here. We came into a 15-minute fair value gap, and in a market where you're bearish and you see the 9:30 Judah swing higher, using a little bit of time right there, you can begin to start framing a trade idea, expecting distribution to the downside towards these lows. Now, obviously, you have to use, like I said, other concepts in this trading. You can't just use the fact that buy side was rated, but because if you were to go through your model and discover that you were bearish and you saw this, this would be A plus entry checklist. And I did take this trade and I just fast forwarded. So give me 1 second. Okay, so we're back here and you can see after this happened, obviously with the power of hindsight on our side, you can see what happens. We took out this low and this low, respecting 50% of this wick and trading lower towards these lows. The next candle, again, lower, and then we came into this 15-minute fair value gap. And if you notice what time this happened, it was 10:45, and then we went a little bit higher and then eventually took out the terminus right here. So all right, and the final way I use liquidity in my trading is to actually enter a trade and as well as some time-based ideas. So what do we have here? The exact same example. I'm going to show you guys how I actually entered this trade and how you could have potentially entered this trade using the same idea. So you can see the buy side liquidity pool was rated right here. I've marked it out as a stop rate. We also have the 50-minute fair value gap supporting our trade idea. Okay, so we have 941 highs sweeping the buy side liquidity pool and a 50-minute fair value gap being tapped in. How can you actually trade this? So once you see that the buy side liquidity pool was rated, you're looking to see that smart money is, or the algorithm is going to be distributing price lower. Because as we said, smart money likes to pair short orders with buy stops. So now that these buy stops were rated, we're looking for shorts because we're bearish on the higher time frame. And we're looking to see distribution of price lower towards these lows. Where could you have potentially entered in this case? So we did have the displacement, which is showing that prices are going to be distributed. However, we do have a 1-minute fair value gap right here, which we're looking potentially for a retracement. And we have a higher up fair value gap right here. In this case, what I did was I pulled out my Fibonacci retracement tool and I looked to get an entry around the Fibonacci retracement zone. So where I actually got filled in this trade was around right there, the 0.62 level. And as we retraced, we could see that price again distributed very quickly. And for me personally, I took my partials at these lows right here. So I'm going to fast forward this. I took my partials right here. And then I left a runner for that sell side liquidity pool. And it did take some time, but eventually you can see we did end up taking that sell side liquidity pool with our initial entry being safe. And so that is how I use liquidity to enter a trade. Okay, so back to the beginning slide. I just wanted to remind you guys the largest takeaway right here is liquidity is fractal, and you're going to need to be able to see the liquidity, or you're going to be the liquidity, right? You don't want to be swept out of a position and then it plays out. So in those examples that we gave, for example, smart money pairs shorts with buy stops, and after this buy stops were rated, right? You don't want to be the person going long here, right? You don't want to be the person going short right here, where we discussed how the sell side was rated here on the S&P divergence, and then price was paired long to distribute towards these highs. You don't want to be that person, right? You also don't want to enter a trade too early. So, for example, people who were bearish and maybe they saw this fair value gap, right here. So I'm going to clear this up. You don't want to be the person who's entering short right here. Why? Because there was no buy-side liquidity pool rate on a higher time frame, right? Smart money isn't looking to sell right here in terms of algorithmic price delivery. But when we did rate the buy-side liquidity pool here, and then we had that 15-minute fair value gap and the premium market, that's where you're looking to sell. And obviously the idea of time on your side too, that's where you're looking for your short. So you don't want to be the person who shorted this. I am saying that because I know some people in my Discord told me they shorted this and they were asking me why they lost, which is again another reason why I picked this specific price fractal and why I shorted up here and not down here. It's the idea of liquidity and of course time and other concepts, but you can definitely use liquidity to your advantage in that specific price fractal again. So back to the original slide, this is what I want you guys to take away. If you guys have any questions, ask me in the comments or my Discord. The next video will be about imbalances, kind of the same idea as this. And the video after that, which is something that's been heavily requested and I noticed people misuse tremendously, is premium and discount. So imbalances, premium and discount are coming next, hopefully next week. If you guys like the video, please subscribe. I'm trying to hit 1,000 subscribers. See you guys till next time. Peace.